The inflation report just came in for December of 2021 at 7% year over year. That means that prices, on average, measured by the CPI, in December of 21 were 7% higher than they were in December of 2020. When we look at month over month, prices rose by 0.5% from November of 21 to December of 21. Now, even though these numbers are higher than they literally have been in decades, they were in fact in line with what expectations were, and therefore markets barely budged at all. These persistently high inflation numbers are putting increasing amounts of pressure on the Federal Reserve to do something about this inflation, especially given the fact that it's literally half their job. They only have two jobs given to them by Congress. One of them is stable prices, keep inflation in check. The other one is full employment. But here's the rub. They've got to choose one or the other, and increasingly, especially right now, it looks like they're losing at both of them at the same time, given that inflation just hit a record high, and unfortunately for many people, wages actually dropped year over year when adjusted for inflation. Ready? Let's dive in. It is not a good situation when the real wages of people in a country are dropping, especially when you are the one in charge of monetary or fiscal policy. Now, luckily, most people haven't caught on to this kind of thing happening yet because people are getting raises. People are getting more money in their wages. It's just not showing up in real wages, and here's how that works. Let's say for easy numbers, you make $100 in a year, and that's what it costs you to live. You make $100, and it costs you $100 to live when you buy the stuff that you need. Fast forward 1 year, and you get a raise for $5. 5% raise, $5. Now you make $105 per year, and you feel great because you're making more money than you were before. What you don't notice, though, is that prices are rising, and it does not cost you $100 to live anymore. This year it costs you $110. So your cost of living goes up by 10%, $10, it costs you $110. You got a raise, so you got $105. When you adjust for the cost of living increase, did you actually get a raise? No, you got a pay cut of 5%. And that is exactly what is going on right now. Over the last year, from December of 2020 through 2021, the cost of living, the CPI, inflation rose by 7%. So when you factor in that increase of cost of living of 7%, you factor that in to the increased wages that people got on average. Real earnings declined by 2.4%. That means the average person got a pay cut of 2.4%. And most people do not realize this. Even the people who have been affected the most by this don't realize that when adjusted for inflation, they are getting pay cuts. People don't realize this because we are so used to just measuring things in dollars. We are not accustomed to having to ask the question, compared to what? Is the price of this thing going up? Well, compared to what? Is the price of my labor going up? Compared to what? You have to measure things in terms of purchasing power, because when you have a quantity of money that is able to be changed and manipulated by a small group of people at will in order to try and accomplish economic goals, you get distortions in what those measurements are. You get distortions in the information that the price of money or the price of anything is sending. And so people are finding themselves making more money than they've ever made before, and at the same time still barely being able to make ends meet. That's not because you need to go to a budgeting course. That's not because you're not paying attention to your money. That's not because you're lacking discipline in where you're spending. It's because you are losing money in terms of real purchasing power as the cost of living increases faster than your rate of pay. And no, this is not the fault of greedy corporations. No, this is not the fault of evil capitalists. Go look at the express purpose of monetary policy by the Federal Reserve every single year for the past over 20 years. Their goal has been to try and stimulate inflation. That's it. That's what they've been trying to do. They've verbalized it. They've explicitly stated, we want higher inflation. They've been printing money, lowering interest rates, and buying assets for the express purpose of pushing up prices for over 20 years. And now it's finally happening, and people are blindsided by it. And people are pointing fingers all over the place place everywhere except the source, which is the money printer. And now markets are pricing in approximately an 80% chance of the Federal Reserve raising rates this year in an attempt to start to slow down the pace of inflation, which at the pace that they're going to be able to raise interest rates, which is 0.25% at a time at the short end of the curve, it is much more likely that it starts to break the financial markets long before it does anything to prices of consumer goods. And as a final kicker, I'd like to throw one chart up on the screen here, and you can see that I've blocked off everything that indicates what this is a chart of, so that all you can see is the dramatic price rise over the last year, 2 years. This looks like a penny stock pump and dump. It looks like an ICO from 2017. It looks like a meme stock from 2020, but in fact, it is none of those things. This asset class has outperformed stocks, outperformed gold, outperformed Bitcoin, outperformed real estate over the last year. And can you guess what this is? Used cars. Used cars up 37% since 1 year ago. And finally, if you're looking for a new platform to trade and invest during these crazy times, check out Interactive Brokers. They've got some of the best tools on the market and the lowest prices for the advanced trading tools that they have, giving you the flexibility to invest in whatever markets with whatever instruments you are interested in. Check them out. I've got an affiliate link in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.